So we have a brand new theme, which is Money Talks, where the international investors look for in return.
Davet edeceğiz. Moderatörümüz Hoftel'den Simon Allison.
So moderator is Simon Allison, Hoftel, president of Hoftel.
Have a seat right over there. Thank you very much. Javier, Arus, Azora, managing partner. Welcome to the stage. Please have a seat. Amir Golbarg, Senior Vice President, MEA&India, Minor Hotels. Hello, sir. Ve Tatiana Veller, Managing Director, Stirling Hospitality Advisors. The stage is yours. Thank you.
Okay, thank you. I guess it's working because I can hear the echo. So I think the first thing we'll do is get everyone to introduce themselves so you know who they are and what their perspective is. This is a session talking about international investors and what they're looking for. The reason I'm sitting here is not, I'm afraid, sadly, because I am an international investor. But I run a group called Hoftel, which is a global alliance of hospitality real estate investors. So our investors, we have, I think, 85 members. They have something like $100 billion of hotels, which is quite a lot, ranging from Blackstone to a family with, actually with none at the moment. So it's a global alliance that brings together owners to hear their opinions. And actually, two of the three people on the stage are our members. Javier and Tatiana's parent company are both members of Hoftel. So I think if we can just basically maybe start with you, Javier, I think. Start with the ladies. Start with Tatiana. And just 2 minutes on what your company does, who you are, and that kind of thing.
Absolutely. I'm audible, right? You guys can hear me? Perfect. I'm actually glad we have a small group, select group, so we'll be able to have an open and honest conversation like we have at your event, Simon. I'm Tatiana Veller, Managing Director of Stirling Hospitality Advisors, and a short way to explain is I think we're a hospitality advisor of a royal family of the Emirate of Ras Al Khaimah, which some of you may have heard of. It is where the first in the Middle East casino is getting built, and it is the Emirate in the UAE that's currently making a lot of waves in terms of the hospitality and tourism development. That's one hat. The other hat, as a royal family office, we own quite a few hotels. So that's my second phase. And a third is that I consult a number of governments and family offices around the GCC region in terms of hospitality investments. I think that's a brief introduction.
All right. Well, on my end, Amir Golbarg. I'm the Senior Vice President of Minor Hotels. Well, we're a founder-led company, born 55 years ago out of Thailand. We represent a portfolio of 568 hotels as of today across 63 different countries. And we're based sort of in 3 different verticals. So we have the hotels, we have food and beverage, where we own around 2,500 standalone restaurants, around 4,000 restaurants globally with our hotels. And then we have a lifestyle vertical as well. And we look at both ownership, management, franchise. We look at the entire vertical. So we have around, out of our 560 plot hotels, sort of a third of them we fully own, we JV, and then the remaining is managed. So we have a full spectrum from lease, managed, franchise, and ownership. So I want to wear a number of hats today, and we look at the entire spectrum of hospitality. So we do boats, planes, trains, hotels, F&B, wellness, and we're across all verticals.
And significant real estate within there, right?
Fair bit of real estate as well, absolutely.
Yeah.
Javier.
Hello, I'm Javier Arus. I'm the managing partner of Azora. Azora is a Spanish private equity firm that we invest in real assets. And within real assets, we have a strong presence in hospitality. We have been investing on hospitality for the last 15 years. During that period, we have deployed or have acquired around 3.5 billion euros of assets. And most of them have been linked to the leisure segment across the Mediterranean. So we're very active in the Mediterranean. I would say we're one of the most active European players in the Mediterranean. and with a strong focus on the leisure, and especially on the sand and beach component, which we were relatively pioneer around 10 years ago. Now has become a much more investable asset class, but when we started, it was quite a pioneer move. And most of our capitals comes from LPs, traditional investors, sovereign fund, pension funds, and normally we will be investing through private equity vehicles with a defined life in the vehicle.
So actually, it's interesting. We have one European investor, one Middle East investor, and one ultimately Asian investor. And I think what's also interesting about you is you have very different kind of investment profiles. You know, you're very institutionally backed, you're a family, but you're listed, and you're a royal family, but you also advise other groups. So clearly you all have a different perception of risk, a different perception of appetite, and I think that hopefully will make this an interesting discussion. I think we were going to start really with the basics, with more or less the physical side of where you like to invest. And the first thing I think we were going to talk about was climate. So obviously, you know, you're all three of you quite resort heavy, although you have urban assets as well. Is length of season, is climate a significant driver, or are you used to places that have a short season? Obviously, places like Bodrum have a short season, Antalya has a longer season, but nowhere here really has a 12-month season. So what's your view on seasonality, climate, and so on? Javier, do you want to be the start this time?
And I think our main driver to invest is leisure.
Right.
Okay, so we're always going to be investing where the European market will deploy its leisure, because we saw some during the conference yesterday. I think was very clear the message about the growth prospect. So in that sense, that's going to be our main driver to invest. It is true that within leisure, with the climate, what's happening, it is affecting the industry in the sense that it is it's spreading out the season, because now today we're probably having better weather in the shoulders of the season and probably worse weather in the peak of the season. So that changes a little bit the way that how we look at the investments, and probably we are de-risking the investment, because now you are not concentrating between July 1st and August 30th 80% of your expected EBITDA. You are spreading it out, so that I think it's a positive effect of it. It is true that it's opening other competitive destinations in some cases that they were not competing against us in the past. And I'll give you the example. We have invested in the Baltic, German Baltic,
right.
Okay, and that's a 365 destinations. So it is having a significant impact. In terms of seasonality, we're a cash flow investor. So for us, it doesn't make a huge difference if we are generating cash flow in 4 months or if we're generating cash flow in 12 months. At the end of the day, it's what's the GOP per key that we're obtaining, okay? And that's what's going to drive our pricing, our CapEx program. Probably it's more challengeable, and we're not very present, but we have a couple of resorts. The climate change with regard to the mountain and ski resorts. There you are running more climate risk. So if you are, there you have to be, a little bit more accurate in what you are underwriting. Okay. I think for the sand and beach, it is less of it's more. I think it's less of an impact, because the risk that you're going to get, bad weather in July and August is very low. On the other hand, it's spreading out the season. But definitely, we are not of our portfolio today. I would say. 70% of the portfolio it's seasonal, right. And 30% it's 365 days.
Okay.
I think traditionally, coming to your point, we were also very heavy in leisure. That's where we started, and that's kind of our DNA. But I think with our investments in NH and how we ventured out in Europe, I think now it's actually much more heavy in that perspective, and we're heavily led now in the corporate markets and in key cities across Europe as well. But I think from our perspective, it's very interesting, because we started our journey being destination developers. We were venturing out, investing in locations off the beaten path, building new destinations up. And I think what I've seen as well over time is obviously climate definitely an impact. But I think it's also about looking at how do you spread your eggs and how do you diversify the demographics and which seasonalities you bring, which clientele. I mean, a good example, we're talking earlier about just example of Dubai. Historically, it was an 7-8 months a market year. Now it's a 12 months a year because they looked at which markets could they tap on into the low seasons who would be keen to come, who wouldn't mind the temperatures. Maybe the rates would be different, but they'll still drive the occupancy and then at least make sure that there's no bleeding over the summer, and then in the winter they maximize the peak. And I think we see that as well in parts of Turkey as well, where they're now starting to look at venturing into other markets in the off-season, where, for instance, the Middle Eastern markets are now pushing into the Egyptian markets and put the North Coast, where you see a lot of demand. And I think for me, where it's really key is that looking at, in particular, now bringing it closer to markets like Turkey and Bodrum, in Antalya, Bodrum, etc., seasons have extended due to climate change, but I think it's also looking at how can we break free from some of the traditional markets and look at newer markets who will be more interested to come. Even in the winter market here, it's still pleasant weather, and you need to now look at diversifying a little bit out. And that's one thing we've realized with some of the markets where it's been heavily seasonal for us, that how can we look at bringing in other markets into those markets. So for instance, China has been a market now that we're slowly seeing come back. Funny enough, this year we're starting to see a major impact of China and the top tier, and they don't mind coming in to the seasons where you don't see the European travelers. You see that now in particular with CIS markets, they're willing to come as well. So we're seeing the diversity happening, and I think for me Turkey is a good example of needing to break free from some of the traditional tour and then pushing a lot more into FIT, and that's where the power of some of these brands and looking at really diversifying that is key. And I think for us moving forward, when I look at investments, we don't mind in seasonal approach, similar to Javier, I think cash flow perspective, as long as you can make up for the period that in particular, if you have here you talk between April and November, and then from that period you shut down, you make up the delta financially from a cash flow perspective, then it's okay. I think moving forward with a lot of the investments that I think we would be looking at is, it's really how can you make sure that you extract more out of less. So in some of these markets where you have seasonal, how can you add new revenue streams to those to extract better longer term seasons? And that's where we've done branded resi in some of these markets, so we can diversify some of these real estate classes. How can we add in timeshare? Timeshare is an area where we've added into seasonal markets a lot. For instance, in Egypt, we looked at the Red Sea. Red Sea is very seasonal, but by adding in timeshare, you suddenly extract a longer period of travel through that. And by adding branded residences there, you can suddenly start creating a more livable space where people will come in off-season, because when the seasons are high, they want to rent out their apartments, make a higher yield, and then in low season, they use it themselves. So you suddenly create an economy within an economy. So you put in, you break down the asset, you start selling off the individual units, you yield off the high season, and then you use the asset in the low season. So that suddenly then creates an economy, both for an investor and obviously for the developer as well.
Anything to add? Yeah.
Sorry?
Is it working? Are you on? They've cut you off already, and you didn't even say anything yet. That's a bit mean. Yeah, it's on now. Yep.
You're on.
Not much to add, right?
I mean, it's very hard to add to what's been said, but I think in the grand scheme of things for Middle Eastern sovereign wealth funds and family offices, climate and weather is probably not even on the radar when they consider investments. Going back to what Amir was saying, it is true that in the GCC in general, I think seasonality has been smoothing out. And it kind of differs also, right? GCC is also not homogeneous. Even in the resort markets, if before we were seeing a huge dip in the summer, now the summer in terms of the occupancies has evened out.
Yeah.
We're still taking a hit on the rates, but guests are there. Looking at places like Riyadh, for example, it's a pure business hub. And I mean, they are almost not dependent on seasonality at all anymore. So However, I mean, there is a bit of fluctuation here and there. If I put on my advisory hat, I would tell people, listen, if you're looking to invest into a market where your season is 3 months, like Salalah, for example, as we discussed before, where, you know, it's, I would say it's a tiny piece of New Zealand in the Middle East. They have rainfalls and, waterfalls and rain and lush greenery, but it's only 3 months a year. What are you going to do before and after? So think about how you're going to shut this down or how you're going to move staff, etc. So, I mean, it needs to be taken in the grand scheme of things with all of the other factors in play, which we'll probably touch on. But, you know, overall, when the family offices in the Middle East think of investing somewhere, trust me, climate is definitely not on the consideration list.
Okay. So let's look at something. When you're underwriting a deal, when you're investing or your clients are investing, how much detail are you looking at accessibility? Do you say there's a major airport, I know there are lots of flights, that's fine? Or do you actually go into detail? Do you look at, you know, how the patterns, the demographics are changing, you know, what new routes are being added? How important is, obviously, broad accessibility is very important for resorts. Although I think, Tatiana, you were also saying increasingly remoteness is also important, and you've obviously got your lodges in Africa, Amir. So, is accessibility the key, or is a little bit of remoteness also good?
I think tourism is changing also, right? It's a lot more about experience than about a lavish hotel room, right? So currently, people like Luxury Frontiers, for example, are doing glampings where you pay several $1,000s a night for a night in the tent. Why? Reason is because it is the overall experience. It's not necessarily the physical luxury of the accommodation. And sometimes having it hard to get there is a part of the experience, actually.
Okay.
And you know, flying into a tiny little airport and then taking a seaplane or, you know, a little propeller plane and then going on a, I don't know, donkey-drawn cart to your destination actually adds to all of the experience. So, you know, again, everything is a part of the business model. Everything falls into an ROI calculation. You know, if it's very hard to get to, are people prepared to pay to get there? Or is this your USP or this is your hardship? So I think you weigh it in a financial model at the end of the day, and you look at it as an investment return.
I mean, for us, it's a critical element. Okay, and I think to have, and when we do any analysis, of course, if you're looking at Istanbul or you're looking at London or Paris or Madrid or Barcelona, it's a non-issue, okay? But outside those big destinations or highly consolidated destinations, for us, connectivity is a key element. First, we are not investing, and I know, I mean, we're not a niche player, but we are not investing, we're only investing in consolidated destinations. So we're not trying to find the new, the new hidden jewel. On the second hand, depending on how accessible your asset is going to define all your commercial strategy. How dependent, it's not only how dependent you're going to be of tour operators versus how much can you do on direct distribution, how much eventually will a brand contribute to your asset versus really relying on the tour operator. So it's a complete different business model how you can do it. I'll give you an example. It's not the same thing for us to invest in Ibiza than to invest in the Canary Islands. Especially in the smaller islands of Canary Islands, in Fuerteventura or Lanzarote. There you're extremely dependent on the connectivity provided by tour operators, where in Ibiza you have direct access to the main airports in Europe. So it has a huge impact, and for us that's critical. And there is like a rule, of more or less for us, if we are more than 60 to 90 minutes away from the airport, it becomes, becomes an issue in, in some of the destinations. So, and that's a critical, that for us is a critical factor.
I think we've been a little bit more bold in some of the destinations we've looked at. I think it all depends on size, positioning, what you're looking at as an asset class as well. I just came in from a new development we're doing in a very untouched part of Africa called Kafui. You can't access the site. But it's really looking at, how do you get there? In terms of positioning, that asset, had that been sitting, and we're positioning that 14 keys, 2,500 to 3,000 entry rate. That's the only way you can do it in that type of location. Because if you don't look at it from that price positioning, then the accessibility, will not reach 90% of the people. We're talking the top 1%. And the top 1% today looks for that, right? They're looking for something that is totally unique, off the beaten path, where 95% of the planet can't reach. So I would not dare going into that space if I didn't know who am I targeting and what am I building for. If I look at, most of our commercial assets where you look at, mass tourism and you want to have accessibility, that's a different story. But for those type of asset classes that we're talking about here, it needs to be positioned in a very high rate, so it's going to justify that, because the cost of getting there alone has to justify the rate that you're charging as well. So it's really calculating the risk and return that comes in with building in those areas. But traditionally, I think it's key to have connectivity. And I think that's one of the privileges we were discussing earlier about Turkey. I mean, it's incredible, the connectivity, the airlines, the airports, the infrastructure. You have it all, right? So I think the challenge and the flip side with having all of that is that then, you've been over-dependent on DMCs and tour operators, and that's then strangled the market. And I think that's the flip side of the coin. When you go in and you build a new destination, you can control and contain what type of markets you want to entertain and what price and positioning you want in the market. But when you've been traditionally open to the level of Turkey has been in Antalya, Marmaris, in other parts, unfortunately, you have to fill the beds, you have to fill the destination, you have to fill the allotments in the airports, and that then triggers the opposite. And then you start suddenly pushing in a lot of mass tourism, and the rates start getting gapped, right?
So I will echo this, because this is what we're experiencing in Ras Al Khaimah currently. We historically have been looked at as kind of a cheaper alternative for people who couldn't afford to go to Dubai, right? And it's been a Hilton town historically. 70% of the room stock was Hilton, and it was all running on all-inclusive, inexpensive CIS, a bit of Germany.
Until we came, of course.
You came recently. Before you, there was an iteration. It's not all about you. So, but then, now with the signing of WIN in the destination, there has begun a clear move towards repositioning the Emirate into a more premier, I wouldn't say luxury, but premier is probably a good word, because we don't want to call ourselves luxury so that we kind of push people away. But higher level, family style resort for a discerning traveler. Right? And this is where we're struggling. It takes years to turn around the image of a destination. Thankfully, we have a very cooperative tourism development authority, and they are working with the business. But now, almost we have what, about 5-6 hotels, including an Anantara, which are positioned in a luxury level at the destination, and they are fighting an uphill battle currently to be able to sell and to be able to position themselves as a luxury property, because overall the perception of the destination is still there as an affordable all-inclusive. And hence, they're having to run packages, right? I know the hotel runs packages, what to do if this is what the public expects. But at least we're starting to be able to make the public pay extra for it. So it takes a while, it's possible, but it is not overnight for sure, and it is a concentrated PR push and a concentrated push by business and authorities alike together.
But what we were talking about, when it's not really part of the brief, but it was quite interesting. Spain had in a way a similar structure years ago with a wholesaler-driven market going pack tours to destinations. And as a result, even today, the big Spanish companies, the Melias, the Barcelos, the Palladiums, they're not as well as household names as the American brands, which relied on FIT travel and loyalty programs. And the solution you're getting in Spain is that the local brands are teaming up with the international brands. So you had, IHG partnering with Iberostar. You've now just had the Bahia Principe deal with Hyatt. So, I mean, Javier, are you actually seeing that on the ground? Maybe you haven't got those assets yet, but presumably the idea is you're bringing in the independent traveler who pays a higher rate. Isn't that part of the theory of this?
I don't agree completely with your,
okay,
with your
good,
statement.
Fine.
Okay, I think honestly, in the origin, it is true that that the Spanish industry, the way it was developed, I mean, they didn't develop any commercial strategy, any branding strategy, because at the end of the day, they sold their entire capacity in the world travel market in London,
right.
or in Berlin in the in the other tour operator fair. So their only concern, they knew they had sold 100% of the capacity. So the only concern was to become extremely efficient in the way they manage the properties. Okay, so they knew the revenue, so they had to be very cautious in cost. And we had developed really industry champions in terms of size and presence, but without very weak brands. I think over the last, I'd say at least 20, 25 years, they have tried to move away, and I think MEA, it's a clear example of really trying to rely more on the branding and reduce the dependency on the tour operators, and that's a progressive progress. But for that, that's a process. But to do that, and we go back to the connectivity, you need to make sure that your guests will access your destination with direct flights, not without dependency on tour operators. And there, I think the low-cost carriers were really, disruptive in the market. So that kind of changed a little bit the rules of the game. Today, what's happening, I would say, is that I will do it on the opposite side. I think the global brands, they have realized that the leisure market is a very attractive segment. It's something that they had disregard with the absence of some of the US destinations, and now they see it really as a growth strategy. And what they are looking is how can we get scale and how we can get platforms in the market. And the transaction that that we saw with Hyatt acquiring AM Resorts is a very good example of penetrating that segment. Yes. Or IHG with Iberostar trying to penetrate the segment, or the other transaction between Hyatt and Pinheiro Group. So I think it is, to some extent, it's not because they're going to be contributing many guests to those destinations, but that the brands really want to be present because they know most of the growth coming in the future is going to come from the leisure space, and where the sun and beach takes a large portion of that. But again, I think, and I also think tour operators, they have gone through major turmoils over the last few years with Thomas Cook. We just saw FTI. But it's true that they also need to change their business model. And I think we need to align much more the risk that's being taken by the tour operator with the risk that is taken by the hotelier. And it should be, I think those dynamics should also be evolving.
And that might make, do you think, if Turkey goes down that road, it may also make some of the assets here more internationally interesting for investors, potentially?
Definitely, yes.
Yes. Okay. We're getting through the session. We've hardly touched the questions. Let's go back, unless anyone wants to chuck anything in there. So we talked about sort of the macro picture, accessibility, climate, and so on. Supply and demand is obviously the most fundamental issue in the hotel market. And again, when you're doing an underwriting, to what extent are you looking at the supply demand? To what extent can you get the data on the supply demand? And is that really important in your decision? And are you looking at, STR, new build statistics, or are you calling GMs and saying what's coming? Can you really analyze it mathematically? Or is it more a feeling? How detailed can you go in that?
Absolutely you can.
Yeah. The data's there.
In today's world, you can extract data on everything, right? And we're a very data, very analytical driven company. We study everything in the market before we enter. From an investment perspective, we look at both past, present, future, and I think there's plenty out there to extract. And I think it's also, what a lot of people then miss out is, the opportunities. Data sometimes restricts you. And I think that's where, the predictability models is one thing, but looking at what else you can extract out of it. In particular, for me, it's also looking at, coming back to a bit of the earlier point, is yes, you may have data that tells you this is the market, this is the cap of the market, but I think what a lot of people miss is what more can you extract out of that? Not what the existing operator is doing or what the existing restrictions on the market is, but what is the opportunities by bringing in, and that's where some of, for instance, for us, we look at the brand, we look at the loyalty, we look at distribution, we look at what else we can extract out of the market. Sometimes I'm bullish about STR, sometimes I'm bullish about these statistics, because for me, quite often, they represent the cap within a market, but it doesn't represent who thinks outside the box, who can do something different. And we've done that in a number of locations where we've really gone in bullish, broke the mold and created something different.
Sure.
And that's where you look at, in particular, if you look at extracting new things out of an asset class, where, for us, mixed-use development is something that we move a lot in. And if you look at purely as a hotel, as a vertical, yes, then the SDR may give you the data. But if you plug in timeshare, you plug in branded resi, you plug in wellness, you plug in your F&Bs, you plug in all the different verticals into it, then suddenly you can change the whole perception of that asset, and you suddenly go into a different competitive set than what the SDR data gives you. So for me, I'm quite bullish of a lot of the statistics, but of course we use it as a benchmark, but then we always look at how can we extract more by adding new verticals to the asset.
Fair enough, yep. Anyone else? I mean, one quick thing. You said supply demand is very important.
For us, the dynamic between supply and demand are critical.
Yeah.
Just to give you a sense, the demand has grown more or less in the Mediterranean around 4% per annum, compounded, over the last 10 years. The supply has grown below 1%. So there's clearly a mismatch between the growth of supply and demand. We know, and if I talk about the Spanish case, and we take it as a proxy for what could be in Turkey, in our case, we know the growth is limited, and it's mainly limited for two reasons. First, because we don't have more land available. So if you want to find a plot of land in Ibiza and in Mallorca, it's no land available. So that's a pretty obvious restriction. And secondly, because their policies will not allow new beds in the system. Okay, so even if you had a plot of land which was buildable because you got it historically for a license, you will not be granted the beds. Okay, so in that sense, the supply is contained. And what they are trying to do, and I think it makes sense, it is to improve the quality of the existing hotels. So they will incentivize, investing and refurbishing and, rebuilding the new hotels, but they will not be granting you new licenses. That dynamic, from an investor point of view, is positive in the sense that, you have demand, and that if you invest in improving the asset, you're going to be capturing that value from the demand. So let's say that is a very obvious case, and that is happening today when we're heavily invested in Portugal, in Italy, in Spain, and those are very similar dynamics in all those markets. So from an investor point of view, it's a good environment. On the opposite, you have markets where they have a lot of growth potential, so there is a space for development. So you have the advantage that you're starting from a clean paper, so you can design what you want to do. So that's very attractive. But then you have to bear in mind that you cannot die of success, in the sense that if you overdevelop, if you don't kind of phase out that growth, you have, there's going to be a chance that you're going to kill the industry in the short and medium term. That happened to us in the Balearic Islands. So we're talking, you need to phase out that growth. You need to give visibility to the investor, saying, look, this is your current environment. This is what you're going to be facing over the next years. And then in next year, we will review if there is need or what type of product needs. So the demand you can generate, but controlling supply, I think it's also a very important matter.
Mm-hmm.
Simon, I think you're underutilizing this panel. You haven't asked us still the most fundamental question. We all come from very, very different standpoints. We almost look at a hotel from 360 degrees, and we are on opposing angles of the circle, right? So Javier is from a very, very institutional PE fund.
Sure, yep.
Amir is an operator and an investor and everything else, and it's Asia, but then they're listed in Madrid, etc. And I represent family offices. We all have very different agenda when we invest in hotels. And we look at and we dissect each hotel investment very differently. For example, if you asked me, I would say that any Middle Eastern-based family office or sovereign wealth fund is playing a real estate game, 1, legacy game, 2, and only after all of that, on the 5th and 6th place, they think about how it's going to operate, what's the climate, what's the accessibility, etc. And number 3 is the image game, right? So most of the sovereign wealth funds, after they have been given a mandate to invest outside of the home market, they go to Paris, New York, Rome, London. Why? Image. And because that is the real estate that is never going to go down unless Earth doesn't exist anymore, right? So this is the first and the foremost game that they play, is real estate. Of course, they're buying a Plaza Athénée for 1.5% yield. It doesn't make any commercial sense at all, right? As well as what's the New York hotel, the Peninsula in New York. It doesn't make any commercial sense, but it is driven by image. They are building a legacy for their family. They have a very long-term planning. They have a very long-term a look at the return on investment, etc., if any. It's not that they don't care about the business, but that is one of the last thoughts on the forefront of their minds. And trust me, as an advisor, as a consultant, I've struggled with this, but I have come to accept.
Yeah, but then they have different pockets, because we also have them as investors, and they push us on return. So they, and we have GIC, which is public. They have become a very heavy investor on the leisure space.
Really big.
Acquire ICOS, Sunny ICOS. They acquire 35% of Blackstone platform. They're LPs with us. We also have some Middle Eastern. So I agree with you that for their own money, probably they're looking more the trophy asset, but for some of their allocation, they're as demanding and and as thorough in an analysis as we do for an institution.
I make a distinction between the family investment and the fund investment.
The fund investment.
When we're talking about the fund, it almost acts like
very institutional,
very shrewd and a lot of scrutiny and everything else. But there is a lot of difference between the way they're thinking.
No, and Javier, I mean, for you, it's very much a financial. You're looking at what debt you can get on the asset. You're looking at how much liquidity there is in the resale market. I mean, you're primarily your numbers driven, right?
Yes, we're number driven, but the number has, we're a value add investor. So we need to create things. We don't buy finished products.
Yeah.
So when we invest, we are looking at, how can we transform the asset from the physical point of view, but also how can we improve the operation of the asset, aligning with the operator, franchising, managing. So it's not just, we're not an opportunistic buyer that we think something is cheap, we buy it, we hold it, and we sell it. But we need to transform in the asset. And also we have partnered up with operators. We have helped operators develop their brands, deploying the capital. So we think we can contribute to the industry. And, and we're talking a lot about this industry, but 10 years ago, there was not institutional capital in the leisure space in the Mediterranean. Today, there is institutional capital. It's a new player in the table, and you can help many of the families with succession issues, with providing liquidity with some of their shareholders, helping them develop the company. So I agree with you, it's financially driven. At the end of the day, we need to make money, but it is very much working side by side with with the operators, with the companies, with the developers.
But I think, just to add to your point, and I think, over the last 6 or 7 years, because we work very closely with the sovereign wealth funds across the region and with a lot of private offices. And actually, I'm seeing a significant shift happening with a lot of these family offices as well. And we've done a number of JVs with them. We've helped them with doing M&A, and obviously entered in a number of acquisition asset rotations for them as well. But they're becoming a lot more shrewd now, and they're starting to really looking at returns. And I'm encouraging them as well, because ultimately, yes, the generation shift is also a key factor. You're now seeing the new generation of these sovereign wealth fund families coming in, and the younger generation have studied abroad, they've understood the values of these asset classes, and they're starting to look at returns. We did a JV partnership with Abu Dhabi Fund for Development, and we ventured that out with our portfolio in Thailand, or in Maldives, Singapore, and other parts of the world. And I'm seeing very clearly now the shift in the generations. And I think we can't underestimate nowadays that there is now a change happening across the industry. And in particular, as these markets mature, you're also going to see the new generation coming in and a very different understanding of the asset classes and how they want to see the returns coming. And I think historically, while that was been the case, now I think it's shifting.
That's why I had to throw it in, so that he would disagree with me.
No, absolutely.
You have the best capital to invest. So we look with envy to you.
But you're correct from the standpoint that the generational shift is happening, and the new gen of the family office heads, they are anywhere between 25 and 35 years old in the Middle East, and they have been Western educated, and they're very well versed in terms of money management, etc. The other thing I think we haven't discussed is how how do international investors speak geographically where, and from the place where I sit, it is very frequently a decision that is driven by things, again, other than climate, accessibility, etc. Sometimes it's political, where they have political connections or where they want political connections. Sometimes it's on a different level of economics, meaning it is not about the hospitality and tourism business at all. It's about you invest in my country here, I invest in yours here, right? And it is on that level. So those things are also driving factors, and very frequently we're in some cases even unable to know about them, and only a few years later it starts to make sense when you see other things unfolding, right? I mean, for me, I still remember 15, 20 years ago, I was like, why is there a Chinese operator of a highway in Tanzania? And then it all started to come together and make sense, right? So those are the other factors.
Yeah. That's a bit more unusual. I mean, for you, it's financial primarily. For you, it's, well, I mean, you have a very different risk profile. I mean, where you have invested, you've been very much a turnaround investor, right? Sri Lanka, Mozambique, Vietnam, even Portugal was always at the bottom of the cycle.
Very much so, but if you look at some of our investments, in particular in Africa, I mean, we're sitting at 23, 24% returns. I mean, yes, some of them, it's difficult, but, it's high risk, high reward in some of these locations as well. And yes, I mean, if you're looking at where you've invested, when you've invested, obviously in Europe, it's a very, very different risk profile you're looking at. You're looking at a very different hold. But I think ultimately, it's also, the appetite that you'll put forward, and also the amount of capital you're disposing in this location. So for us, yes, we've been quite bold in some locations, but also now what we've learned is you need to diversify and you need to, spread your eggs. As much as we're looking at what we're bringing into our locations in terms of demographics, but also in terms of divesting across. We would traditionally, if you look at 15 years ago, we were 90% Thai in Asia, and we saw the hit in 2008, 2009, and that hit us extremely hard. And then that was the learning curve to spread our eggs out. And you saw now in COVID, while some markets were down, Maldives, Middle East, and those parts were tremendously up. So, you balance it out. And I think it's a very different, it's about understanding how do you want to spread your eggs. And I think that's where bringing it back to Turkey again, and I think it's important since we have a lot of Turkish audience. And that's what I'm also trying to urge a little bit on the Turkish market as well. They need to start looking at spreading their wings a little bit more, making a little bit more, both for, a lot of the local homegrown hospitality owners, developers, and operators to maybe start venturing out and getting a little bit more bold and bringing more diversity in, and also encourage more FDI. And to do that, you need to open up some of these markets that we discussed.
I think there's no question. I mean, I know you discussed it a bit yesterday in this conference, but, there are precious few, almost no really Turkish brands that have gone out and conquered the world.
That's it.
Most tourism destinations have one. Spain has them, Thailand has them, France has them. Turkey hasn't yet had
They haven't yet anchored that, and I think maybe through a collab that would happen.
JVs,
through JVs, collaborations, and maybe expanding that out.
But if I were the manager of a Turkish family office, I would be overweighted in Turkish tourism.
Of course you would. Of course you would.
I think the local money has to, it's a clear, it's so obvious the opportunity that, if I was a Turkish institution or a family office, I would clearly overweight tourism in the portfolio.
Yes, and clearly geopolitics has a role. I mean, if you want to bring in joint venture investors here, clearly the geopolitical positioning of the country has changed in the last 10, 20 years, and that's obviously influencing where you're likely to get your investment from. And I don't want to be, I'm not making a comment on what the policy is, but clearly as you distance yourself a bit from Europe, it's harder to get European investors. Maybe it's easier to get Russian investors or Middle Eastern investors. So I think as a country, you have to bear in mind that the big picture also trickles down to the little picture, and I think you'd all agree with that. Look, we're over time. I think we covered about a third of what we wanted to cover, so it's been a great panel, and thank you all very much.
Thank you very much, everyone.
Thank you.
Thank you.
Oh, photo.